Thinking about making a holding company? Well, just hold on for a few minutes and watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, talking about how to structure your business is a key conversation we have every day. Now, in this video, I wanted to talk to you about holding companies. I'm going to recap what a holding company is, why it's not a miracle tax solution, and why actually it could be the opposite and cost you money. And the reason I wanted to do this video, we already have another video on holding companies, a little bit old, so I thought it'd be good to update it. But also, particularly, I think there's just a ton of content out there at the minute on other platforms, particularly in Reels, where they're just showing you almost half of the problem, half of the solution. And it's making people think, actually, I'm missing out here. I should have a holding company. It's going to save me a bunch of tax. I'm absolutely going to debunk that in this video, why actually, in most cases, could actually cost you money. So let's start with the recap of what actually a holding company is. Now, holding company is just a term, really. In actual practical terms, it's just another limited company. So if you imagine you've probably got your normal business that's a limited company on its own, and then on top of that, you might well have this holding company. That's how it would normally work. So you've got kind of the limited company trading business down below, which is your current business. And then you've got this holding company up top. So it's just another limited company and it owns the bottom one, usually 100%. So if we just take a general scenario where you're the owner manager of a small limited company here in the UK, you might own the holding company shares 100%, and then the holding company owns 100% of your trading business's shares. So it's just a very simple structure like that. And that's the kind of structure that we're talking about in this video. And those kind of structures are normally put in place for safety rather than tax. Safety rather than tax. That's always a thing to think about. And the reason is that people like to ring fence their money. So as things happen and the trading business starts to get some cash, it might want to do something with it. It might decide, actually, I want to go invest in property, or actually, just want to go and do something somewhere else. And I worry about it being in my limited company. Maybe the limited company is a bit risky. Maybe you're worried about getting sued or the business going down or something, or, you know, you're in one of those markets that it's busy right now, but you're worried about it being quiet later. And where the holding company can be quite good is you can send money up via dividends. So it can pay its profits that's already paid tax on them, and they go straight up into the holding company tax-free. And I think people think that and think, oh, that's cool. That means that there's no tax, but obviously you've paid corporation tax down here. And that's the most normal way we see it, and where we see the most use is because somebody wants to do something with the money. Then the holding company might then go on to invest in property or do its own thing and run its own maybe property business out of that company. And that's completely safe if it's done properly from the trading company's kind of outlook. So if the trading company ends up going down for some reason, then the money over here in your holding company is not actually affected. So that's a really good thing. And that's generally what we see, is that's more that safety idea over tax or any other reason. Now, the interesting bit here as business accountants is, you imagine thousands of businesses we've worked with over the last 18 years odd, we very rarely ever form them when the structure occurs at the beginning. So when you're starting your business, it's very unusual to do it. And the reason being is that it's going to cost you money. It's going to cost you money physically in accounting fees and also in hassle. There's quite a lot of mistakes we see where people treat the two companies almost as like one bank account, and there's a bit of a slush fund, and people don't keep this sort of line drawn between them, and you end up with this weird thing where one owes money to the other, and actually it sort of almost kills the whole idea of it being there and ring fencing this money. It's probably a subject for another video, but just know that there's an admin cost as well as accountancy fees, and a lot of people telling you these things are great and you should have them from day one have normally got a vested interest in doing so because perhaps they sell accountancy services or some other sort of services that is needed for this company. So just bear that in mind when you're listening to this kind of information. And again, there are scenarios though from day one where actually it is good. So we work quite a lot with property developers, for example, and quite often they will ring fence each property in a company. So that's quite normal. You might have heard the term SPV or come across this term SPV, special purpose vehicle, a bit like holding companies. It's just another like term for another limited company. And it just helps with that risk and ring fencing things again. So there are scenarios absolutely where this does make sense, but in the general starting a new business, it is very rare to actually start a holding company day one just on a practical level. Now, if we take the actual costs of running this other limited company to one side, the other reason it costs you money, and this is really quite important, is the tax rates. Now, this is going to be a little bit technical, but I'm going to do my best to explain it in the simplest sort of terms. And as always, with anything with tax, there's caveats and everything else. So I'm just using a broad, very simple example. But what generally happens is that when you have under £250,000 of profits in your trading business, you're not paying the main rate of corporation tax. The main rate of corporation tax at the time recording the video is 25%. And what it allows you to do is, for various reasons, is the first £50,000 of profit, and this is the bit I want you to focus on just for this simple example, the first £50,000 of profit is only taxed at 19%. Now, that's fine for a single business, but there's something that's often referred to in our game as the associated companies rules. And that means in that simple scenario we're talking about, where you're the whole owner of the entire structure, you own that holding company that owns this trading company, those two are going to be associated. And what happens then is that limit, that £250,000 limit that we were talking about before you start paying the main rate of corporation tax, is slashed in half. So you slash it by however many associated companies you've got effectively. So in this example, we're just adding another company, so that's halved. So it's now £125,000 before you start paying the main rate of corporation tax. And it's the same thing happens at the bottom level. So that £50,000 limit of 19% now becomes 25,000. So if you imagine, if you've got this associated company there, where this holding company is actually in play doing something, and I'll talk about that in a moment a bit further about what counts. This associated company is in, and it means that if you've got profits, say you're making 35,000 in the company below, that now was all at 19% profit until you added this associated company, and now suddenly the bit that's over 25 grand is going to be taxed at a higher rate than 19%. So it can actually cost you tax in this scenario. Now you might think, yeah, but holding companies surely don't count, and that's another myth. And what doesn't count is what's known as a passive holding company. It's very technical and very defined in law, but it's a very narrow thing. And all it says is that we won't count holding companies if all they do is receive dividends and basically just pay them straight out. But in a lot of scenarios that are being shown online, that's not actually what's happening. And for a lot of practical reasons, in many holding companies, that isn't what they do. They actually might invest that money and carry out a property business or something like that. And that brings us, I suppose, to the kind of tax myths. And that's this idea that this holding company can charge management charges, as is often known, or some other sort of licensing or some charge to the trading company. And there's actually nothing wrong with that. It can, and it actually makes sense in a lot of structures as well. So there's nothing particularly wrong with that. But I would say there's a load of caveats around this to make sure that it's actually technically a legitimate invoice from one to the other. It makes sense from a commercial point of view. It's wholly and exclusively incurred in the other company that wants the tax deduction. There's a lot of things around it, but let's just say in concept it's absolutely possible. But what you're seeing on some of this short form content is they'll show you the holding company charging your trading company all these fees, and it reduces the trading company's profits to zero, and then they've saved all the corporation tax, and it's like, wow, that's amazing, we're going to pay no tax. Well, they're not showing you the other half of it. All we've done is we've moved the profit that was in this one up here, because the holding company's now just received a load of trading income and it's got its own tax bill. And as we've said, if they're associated, you might even cause yourself a different tax bill in a different place. So do know that these management charges are technically taxable. You're just paying tax somewhere else. And again, sometimes there's a tax benefit to that, depending where your costs are and who's paying for what. But do know that all you're really doing is shifting it around. And then the next natural thing, and I've seen this in some of the comments of the content we put out, is someone will say, oh, but hold on, I'm just going to go and buy a property, so surely that wipes all the profit in the holding company out. And that's not true either. For lots of technical reasons, that initial purchase of the property is not going to suddenly wipe out all of the profits. And neither is borrowing a load of money to buy the property, although you will likely get interest relief on any mortgage you have. If you imagine you've received all this money in one chunk, and the timing of how all those mortgage repayments are going to come out, very rarely, I've never seen one, and I doubt I ever will in my lifetime, see a scenario where all of those profits are wiped out by borrowing money. It's very, very unlikely. But again, that's probably an entire video on its own, showing you spreadsheets to prove that. But do know that it is very, very unlikely to be the case. So you're still going to have a tax bill, you just moved it around. And again, caveat, sometimes moving that profit around to the holding company, depending what it's doing and what its costs are, can be good. But I just want to get this idea out of your head that you're missing out if you're in early stages of businesses and you don't have a holding company, or even maybe you're further along in your journey and you're thinking, well, should I have one? Get some advice on it from a professional level. Just look at the actual numbers. Does it actually save you any tax? Because in a vast majority of scenarios we see, it would actually just cost money either in tax or admin or fees to do these things. So if you are listening to this and thinking, actually, maybe I still do feel like I'm missing out, or then maybe there's something in it, aside from getting professional advice, there's another video here that could help you dig a little bit deeper into this topic. I'll see you on the next one.